So tonight's moderator, the panelists will introduce themselves, and Mike will get to that in a moment. But Mike Paterakis is the data and benchmarking editor across the Infopro Digital titles. He's got a storied background in working with HFM CTA Intelligence Magazine. We're a long-term subscriber. And he was the covered asset manager of Institutional Investor. So now, without further ado, please help me welcome our panelists this evening, and we look forward to it. So, thanks,
Tim. Thanks, Tim. Thanks, everybody, for being here with us tonight. This is going to be a very interesting panel because I think commodities and what is happening with the markets. Sorry, can you hear me well? Because I know that. Yeah. Perfect. So our topic tonight is very interesting, given everything that is happening with global markets. As Tim mentioned, my name is Mike Paterakis, data and benchmarking editor at Infopro Digital. With me, I have Paul Lucek, CEO and co-CIO of Ridgedale Advisors, and Andrew Weisman, co-CIO and partner at Windham Liquid Alternatives. I'll let them introduce themselves properly, but some housekeeping rules first. The session will last for approximately an hour. I'll keep it to our discussion for the first 45 minutes, and then I'm going to leave the last 15 minutes for a Q&A session. Paul, want to tell us a few words about yourself?
Sure. So, Ridgedale Advisors is a systematic global macro investment manager. Our predecessor company was formed in 1983 by my co-CIO, Mark Rosenberg. We were independent from 83 through 2001 when we joined up with State Street Global Advisors, and we renamed the firm to SARIS, which stood for State Street Absolute Return Investment Strategies. And we worked with State Street from 2001 till 2014, but it became very difficult for a hedge fund firm to be under a Fed-governed bank due to Dodd-Frank and the Volcker rules. So we purchased back the company from SSGA Management, bought them out, and we formed Ridgedale. So we've been operating Ridgedale since 2017. We have both commodity funds that have alpha only and alpha plus beta, as well as an absolute return program. So we trade systematically, and we're a global macro manager. My own background, you may have seen my bio, I didn't come through business school or economics. I was a scientist. I was majored in biology, and then moved on to an MD PhD program in Columbia Medical School. But I was always looking at statistical approaches to biology and looking at signal in the vast sea of noise that is the human genome. I found the same sort of mathematics could be applied to markets, and I made that transition into finance.
Thanks, Paul. Andrew?
Hi, so I'm the Chief Investment Strategist at Windham. Wyndham's been around for about 30 years, founded by Mark Kritzman, and it seems that we share some DNA. He founded State Street Advisors, which is essentially the research arm of State Street. The firm is kind of research intensive. Going back several years, or I guess almost 20 years, there are very few years where someone at the firm hasn't won a major research prize. I even actually got a couple of those myself that my mom's really proud of, including the Bernstein Proposing Prize from the Journal of Portfolio Management and the Roger F. Murray Prize, which I frequently refer to as the Fred McMurray Prize, which is something completely different. And the firm has been a specialist in basically quantitative risk-focused strategies. And we also have a software company as well.
Thanks, Andrew. So to kick off this discussion, let's set the stage by I want to ask that because I think that is in many people's minds. Andrew and Paul, what do you expect to see from the Fed's monetary policy for the rest of the year? Do you expect the FOMC to raise rates by 0.5 basis points? I guess after Jay Powell's speech today, this is given, but like, what more do you expect to see? Are we facing like a stagflation environment at this point? What's your take, Andrew?
Oh, okay. Okay, I'll start.
No one has to take.
Sorry. I want to hear what he says.
I believe that the Fed is actually behind the curve here. In the beginning, we were expecting 25 basis points every meeting. That was what was telegraphed. That's what we were thinking was going to happen. And there were a lot of calls saying, no, this is, inflation is too much, it's too high, it's taking off, you've got to react more strongly. They've come around to that. There was some talk of 75, but that was just, on the outlier. So, and today we heard it's going to be a 50 basis point raise. The question is it going to be followed by multiple 50 basis point raises? Is that the extent of what they're going to do? The normal progression of the Fed was to meeting, raise, intra-meeting, pause, meeting, raise, intra-meeting, pause. And they said that that's out the window. It's going to be raise, intra-meeting, raise, intra-meeting, raise. And those were going to be 25s. The problem that I see is that the Fed is trying to fight something economically that it can't in terms of trying to control inflation. But as we're going to discuss today, there's so much structural parts to the inflation that raising the interest rates, it's going to affect wages, it's going to affect housing, but to affect commodity prices, it's going to be very difficult in this environment.
Andrew?
Okay. Okay, here we go. I guess you can hear me now. So I'm kind of looking forward to getting old. That way I can be really opinionated and people will just say I'm alone. So my advisor, when I was at the doctoral program at Columbia, was a guy named Rick Mishkin, who eventually went on to become the vice chairman of the Federal Reserve. And so my background is a lot of the math related to these sorts of issues. And one of the most important insights that was obtained, particularly in the field of rational expectations econometrics, was, and part of my comprehensive exams involved doing this 8-page closed-form solution proof of the following very simple notion, which is if you have a monetary authority, which basically has the same information set as a collection of rational participants, and rationality in the context of econometrics is a statistical concept. It doesn't mean everyone's rational all the time, but just generally speaking, free money doesn't lie around on the street for any length of time. But if you have this group of people that have essentially the same information set that the Fed does, that ultimately any attempt to constrain volatility, a feedback mechanism will be in place that serves to amplify volatility. And one of the most notable cases where you could see that on a regular basis was when the European monetary system existed. So you had all of these central banks stepping in saying that the SEDA is going to stay against the Deutsche Mark at the falling rate, despite the fact that rates are 11% in Spain and 4% in Germany, but we're going to maintain this parity despite the fact that the world could step in, borrow money at 4%, lend it at 11, and make free money. And that would happen until the point that it didn't happen any longer, and then the markets would just explode, and George Soros would get tons of money. So what we've been in for an extensive period of time is a period where the Fed has been stepping in, along with other central banks around the world, to really compress interest rates, to keep them at a very artificially low level, an inappropriate level. And one of the things that kind of bothers me, and I sit and spend most of my day yelling at the television as guests come on Bloomberg and disagreeing with what they say. When they talk about the yield curve, and you probably say, oh, the yield curve means this, it means that. But the yield curve actually represents in a world where the Fed is buying virtually every dollar that's being issued by the Treasury. The shape of the yield curve is reflective of not a revealed preference of what investors are thinking. It's a series of policy decisions. And so it's almost meaningless. But I think one of the things that we can look forward to from a theoretical perspective, and I think we're starting to see it already, is this attempt to compress and keep rates at a very low level, despite the fact that inflation is running at least at 8.5, and is probably dramatically understated. We're going to see a move up in rates that's going well beyond what is expected. And it will happen much more vigorously than a lot of people anticipate. And if just as a one last little thing, the last time we went through a rate hiking cycle, the 05 through 07 period, where the Fed wasn't anywhere near as far behind the curve as they are now, the Fed raised their Fed funds target 25 basis points every 6 weeks, 17 times in a row, which at the time I was thinking this has to be part of a social welfare program that's not been announced called No Trader Left Behind. It created huge amounts of autocorrelation in the market and made it very easy to make money. So I think that's kind of what we're dealing with right now. We're starting to see it, and that's something to look forward to if you trade. If you're worried about the economy, maybe it's not something to look forward to.
So the Fed, like right now, is like, that, at least that's my sense, very preoccupied with what is happening with the stock market, simply because all of the people's money are tied there, like mostly retirement money.
Right.
And as you said, like no traders left behind.
Yeah.
Like, that's the new motto. However, that since the beginning of the year, we've seen like markets crumbling. Is there like any market out there that you feel bullish for? Because I was going to ask if you feel bearish about something, but I guess both of you are bearish about many things. But like any market that you think it's worthwhile to take a look at this year?
That's a layup question. The title of our panel, but yeah, I mean, obviously, in this environment with inflation at double digits and increasing, yeah, commodities are definitely the market that you want to be looking at, for sure.
I would say definitely within certain commodities, but also being short the bond market is a wonderful thing to do. And implementing some sort of an interest rate momentum program that specifically focuses on that in this sort of environment, I think is going to be really, really helpful.
So, like, given commodities, like, are we entering, like, and I see this term coming up more and more, like, from my colleagues, but, like, are we entering a commodities super cycle at this point? And I want to ask as a follow-up to this, is this because of, like, increased demand or because supply collapsed? What's, like, the key trigger for that?
So, in terms of a super cycle, I don't know if it's too early to say that we're in a super cycle now. The past super cycles have been caused by vast paradigm shifts in terms of industrialization, World War II, the BRIC, Brazil, Russia, India, and China, those countries becoming industrialized, especially China. Right now, it's a combination of supply and demand. We have definitely increased demand coming out of COVID. We have decreased supply due to supply chain issues, due to the fact that prices have been compressed for so long that the investment in obtaining commodities has been declining over time. And this is not something that can be put on extremely quickly. This is something that takes a long time to bring back. So the combination of increased demand due to COVID lightening up, decreased supply due to price depressions that we've had over the past 5-7 years, this is all coming together to provide at least, call it a 5-year cycle of commodity appreciation, if it doesn't turn into a super cycle that lasts, a decade or more.
We had a super cycle 3 weeks ago, nickel market. Traded from $25,000 a ton to $100,000 and then back. So that's kind of a cycle. The reason I bring that up is that there's some really interesting features of this sort of stochastic or probabilistic profile in the commodity markets, which is returns in the commodity markets on individual commodities tend to be dominated for very long periods of time, but very short-lived supply-demand considerations. So, and the reason for that is you have this big right tail to the distribution because you're dealing with essentially an inelastic demand for this asset class. And every once in a while the supply goes away and the market just clears wherever it's going to clear. So if there's a war, a drought, a frost, people like Paul will still selfishly insist on feeding themselves and their family and heating their homes. And the market just ends up clearing wherever it's going to clear. I mean, we had natural gas prices in March in Europe go up 55%. And that's because the supply went away, basically, or almost went away. So it's very difficult to make a sort of long-term global, it's like Niels Bohr said, we appreciate physics. Forecasting is very difficult, especially about the future, and that's really true, particularly in the commodity space.
But to add on what you're saying, in terms of some of these prices that are going up, some of them are long-term situations.
Yeah.
The move to electric vehicles, so cobalt, lithium, nickel, the move towards greener energy products, copper is one of those commodities that, if other commodities are not in a super cycle, something like copper could be, because it's involved in solar panels, it's involved in batteries, it's involved in just electrification, which is moving away from sort of petroleum-based products. But it's just a rotation from one type of commodity into other types of commodities.
Yep.
So it's interesting that we're discussing commodities right now, like everyone is like obsessed with what is happening with commodities, and yet for the past decade, you would if you were to go through the asset allocation of institutional investors, all the pension plans, foundations, endowments, you would hardly find any commodities allocations. So I'm just wondering, are commodities an asset class? And if they're truly an asset class, are in the minds of investors at this moment? Have you had any investor interest so far?
Yeah, the commodity stuff is of particular interest to people at the moment because there's a lot going on there at the moment, and it's sort of interesting how you would build commodity exposure into a portfolio. So strictly just going out and buying a Bloomberg commodity index, probably not a great idea. And it's not a great idea for a number of reasons, but one of them is that essentially what you end up owning is the front end of the term structure of the futures market, and you're going to be paying away the so-called convenience fee. So which is probably the richest risk factor in the commodity space, which is you tend to get paid for taking the other side of a trade where a hedger is looking to hedge something out in the distant future, and you're stepping in to provide some liquidity. And you get essentially what's known as a convenience yield or backwardation in a number of these markets. And by being long the back end and short the front end, you can do extremely well for yourself if you learn, first of all, how to manage the risk and which commodities not to do. So my advice to you is, don't ever short the front month in the natural gas markets. If you like abuse, you can stay at home and abuse yourself and save yourself a lot of money, but just don't do that.
Especially in the month of March.
Especially exactly. Especially during the winter months, the weather months. So there's commodities and there's commodities, and their momentum is there's a wonderfully rich risk factor in commodity space. And once again, you have to kind of know how to do it. You have to be very cognizant of where the distortions are in the term structure, and only be buying stuff that's underpriced, or if you're shorting, only be shorting stuff that's overpriced. And then finally, there are some great relative value positions that you can do. You're long baskets of commodities that are in significant relative backwardation, and short stuff that's in significant relative contango. So what I wouldn't do, because one of the real key features of commodity markets is those prices mean revert. They go up and they come back down, and they can do so very suddenly.
I definitely agree with my colleague on this, especially the need for active management in the commodity space. When you think about a commodity index, imagine if I created an equity index that has 25 very large global stocks, but 2 of them are priced only on North American exchanges. All of the rest of them are priced on other exchanges. The prices, the weightings in the index are including volume and capitalization, except for 3 of them, it's only volume and no capitalization. Okay, well that's like the Bloomberg Commodity Index. It's the rule set is so convoluted And there are so many different opportunities within the commodity space to capture alpha that you could really have the same return, when commodities are screaming. You could capture that return, but you could do it with half of the risk. So it's much better to be in an active commodity space. And at Saris, while we were at Saris in 2006, we launched 2 commodity products. One, which was alpha plus beta for those clients who wanted to capture, what the index was getting plus an alpha over it, as well as a alpha-only index. And in 2006, most consultants were saying somewhere between 5 to 7% of an allocation to commodities. We were having a super cycle based upon the BRIC countries, in the early 2000s. But then the global financial crisis changed all that in 2008. That, I believe, is when the institutional investors really pulled away from commodities. And the reason for that was that commodities were minus 0.4, if you look at a quarterly correlation of commodities to the S&P. They were minus 0.4 coming into that period, and they jumped to plus 0.7. So people looked at their portfolios and saw stocks going down and said, look, my commodity position is losing terribly. Where's the hedge? And they didn't think about it from the very, very long term. So it went from minus 0.4 to plus 0.7 during the global financial crisis. And it stayed high until recently. And now it's back down at minus 0.2, and it's heading lower. So I think we're just on a precipice of commodities being interesting again as being something that you could actually put alongside equities and fixed income. Here's another asset class. And in all honesty, commodities are not a singular asset class, because if you look at the average correlation of equities, it's pretty high when you look at equities within an equity index. Look at the average correlation of bonds in any bond index, that average correlation is going to be high. The average correlation of commodities are low. You have energy, and even within energy, you have petroleum versus natural gas, grains, precious metals, softs. I mean, the number of asset classes within commodities is actually quite large. So again, you have another opportunity from a dynamic asset allocation to capture alpha in terms of allocating across these different asset classes, which are in commodity asset class, that can be provided to a portfolio alongside equities and fixed income.
However, Paul, if I'm an institutional investor, let's say I'm Illinois Ditzers or CalSTRS, and I want to invest in commodities, do I go directly, myself, and to do that, or should I go through some manager, through my Crisis Alpha program, for instance? And I'm asking that specifically because CalSTRS has one such program, and that includes lots of CTAs. I'm just wondering, do they call? I mean, they don't call this commodities, but is this a good enough exposure to commodities at this point in time?
I definitely want to go direct into an index, as my colleague pointed out as well. It's clearly a very large advantage to going to active management, to go to. I mean, the opportunity to collect alpha in this space is large. And over the past quarter has only gotten larger, with interest rates going higher, inflation going higher, and equity risk as high as it is right now. The opportunity set in commodities has expanded. And then add on to that the geopolitical situation with the war. We were already moving, I wasn't speaking about the war up until now, but we were moving into this great opportunity for commodities prior to the invasion of Ukraine, and this just magnified the whole process.
Yeah, it has provided a very rich but unpredictable opportunity set, and it's good for business, but you don't want to be triumphalist about this because it's all the human tragedy that it has created a continuation and of the pressure that's being placed on the Fed at the moment. Since it's Thursday and we're drinking a little bit here, I thought I would share a little story about something. So I used to do a lot of traveling. I still do a fair amount, but not like I used to do crazy amounts. And I, at one point, got a letter from Jeff Smizek, who was the CEO, personally thanking me for riding on his plane so much. And I would be let on really early, and I got on this one flight to San Francisco. This is going back about 8 years ago. And this little lady comes on after me, and She had a big suitcase. I figured I'll be a nice guy and I'll help her up with it. And I looked down, it's Janet Yellen. And so I put the suitcase up and I said, that's a really heavy suitcase. Now I know where you've been stuffing all those bonds you've been buying. I swear to God. And she looks at me and she goes, you know who I am, right? And she goes, do you think I'm famous? Which is just kind of, but the subtext of that question is, am I too famous to be riding around on public transportation right now? Maybe that's too dangerous. But in any event, so, you know, this has been going on for a while, what we're experiencing right now, this massive accumulation of debt, and you can't forget about where we're at right now. This is a really peculiar moment in history. And if you think about what your real historical precedents are, it's the First and Second World War. I mean, we're at about 130% of debt to GDP, which is roughly where we were during those 2 points in time. And what happened? Well, we had 5 years of raging inflation, and that's kind of where we're at the moment. If you take a look at, you know, any of the monetary aggregates like M2, we've been experiencing unprecedented growth in money supply. And you know, when the pandemic first kicked in, you saw a big jump in savings, so that sort of compressed the velocity of money, the rate at which it exchanges, and sort of effectively contracted some of the bigger aggregates in terms of measures of money supply. But that's all reversed. And so we're in a period right now with this really significant excess demand. And that's really the problem. And commodities will probably be a beneficiary of that. And the bond market will be an anti-beneficiary of that. And we're going to see potentially much, much higher rates. And what does that do? Well, that changes the world we've been living in. So the world we've been living in with zero interest rates is money received, you know, remember, you ever studied the time value of money? Money received in a zero interest rate world 10,000 years from now is worth the same as money received tomorrow when interest rates are zero. And so stocks that have very distant earnings prospects, they're the ones that go up, and the ones that go down are ones that make money now. And so all of that style rotation is going to take place in the equity markets. But you know, we're in for a really, really troubling period. And the one thing that you have to bear in mind, and I've seen this, is most people have this structural model in their head. And that model is one where if stocks go up, bonds go down. Bonds go up, stocks go down. Well, if you take a look at what was originally, I guess, the Weisman egg and the Barclays egg and then the Staples Center egg, you know, it keeps changing names, corporate sponsors. You know, fully 72% of the time since the 1950s, stocks and bonds have actually been positively correlated in terms of price. And whenever the yield on the 10-year note got up above about 4.5%, there has never been a 2-year rolling window where the correlation between stocks and bonds has not been positive. So, you know, in all likelihood, what we're looking at right now is a period where rates move significantly higher, where you see significant style rotations out of growth stocks into value stocks, and in general things move down and simply don't perform very well. So, you know, where are you going to go? And that's really the issue. And there will be significant disruptions in the commodity markets, which Paul has been pointing out, and there's very rich opportunities out there.
So, like, when most people are talking about indices, they talk about, like, stock indices. I have the bad habit, though, having edited the magazine that focuses, like, on commodities, to really, like, pay really close attention to the SocGen indices. And I see that, like, trend followers, systematic trend followers, are up, like, 25% year to date. Traditional CPAs close to that, like, I think 18 to 20% so far this year. The same with short-term traders. I'm wondering if these impressive results are, like, due to allocation to commodities or something else. But my sense is that it's the commodities markets, that they have been, like, a real boon for all, like, systematic traders. I just wanted to also, however, hear your thoughts on that.
I mean, the commodity move was definitely a substantial portion of the first quarter's profits that we've had. But as well being short rates was a huge contributor, and as well being short equities. But both of those added to our performance. And within the commodities, it was largely metals and energy and grains.
Yeah, the word acronym CTA is a bit of a misnomer, and it should be futures traders rather than commodity traders, because when you get really big as a CTA and you have to deploy capital, you're going to be deploying capital to places where you can deploy capital. So your asset allocation decision is really imposed upon you by the relative liquidity in futures markets. So what you find is if you're managing, $5 or $10 billion as a CTA, guess what? Half your portfolio is going to be fixed income futures, about 30% might be in FX, and then the remaining chunk is going to be in other random stuff in the commodity sector. From what I've seen, the bulk of the P&L that's been generated has been generated primarily by capturing trends or autocorrelation in movements in interest rates. That's really what most commodity trading advisors are doing, even though the bonds really not a commodity, so at least in the traditional sense of the word. Yeah.
So when it comes to commodities, do commodities have a risk premium? Where does this come from? Paul?
Sure. When, in terms of the investment of commodities, and at least in terms of buying a futures contract, you can think of a futures contract across the participants in that market as being an insurance contract, insuring against price volatility. So the higher the volatility of the spot price, the higher the premium that you're going to capture within that futures contract when you purchase or sell that futures contract. So the higher volatility occurs typically when commodities have low inventory levels. So futures contracts typically insure against future price volatility when inventory levels are low. And we saw that as mentioned with the nickel contract recently. When inventories get super low, volatility can explode. And the risk premium that you can capture from commodities and commodities and asset classes associated with that low inventory level. So systematic methods that assess inventory levels or approximate through other mathematical measures commodities when they have low inventory levels versus high inventory levels or average levels. Those are the types of approaches that we use to separate the commodity markets and try to take exposure to those ones where we're going to capture the most risk premium. But as an asset class, you'd think stocks have earnings growth, fixed income has credit risk and duration risk. People say, well, what's the risk premium in commodities? It has to do with the insurance value of the futures contract on a commodity and controlling volatility or collecting risk premium based upon volatility tied to inventory levels.
What he said. Yeah, I agree with that. There are some interesting risk premia, and there are different ways of harvesting them. But by and large, what you do is you're providing liquidity in situations and taking the other side of trades that very big participants in these markets have to engage in. So, you think about the wheat market. Canada, for example, all of their wheat, and they produce an awful lot of wheat, is purchased by one entity, which is the Canadian Wheat Marketing Board, and they're going to hedge that entire nation's production, and that's a big trade to do. And so, one of the key risk premia that's talked about is this whole notion of convenience yield, where you are essentially compensated for participating in that situation in owning the kind of deferred contracts and watching them ultimately accrete to what's going on at in the spot market. And so that's a pretty robust risk premium. And another risk premium is just this whole notion that these markets engage in fairly autocorrelated changes in prices over time. So momentum is not just a feature of the interest rate markets, it's not just a feature of the equity markets, but it can appear in the commodity markets if you know how to harness that. And there are right ways to do it, wrong ways to do it. But that's a very rich anomaly. And it's from a portfolio construction standpoint, I mean, I wouldn't put everything that your mom owns into that. But it's a really useful thing to do. And if I could give you just a little intuition as to why that's the case. But when you're implementing a momentum strategy, there's been a lot of good research that indicates that these momentum strategies effectively replicate the owning of a straddle on the movement in the price of that underlying asset. And essentially what that means is you own and replicate the equivalent of an insurance policy that protects you against prices moving up, and another insurance policy that protects you against prices moving down dramatically. And so your peak periods of performance tend to coincide with exogenous shocks that happen in the market, these things that are unforecastable. Wars, droughts, frosts, all those sorts of things. And the payoffs, which can be very substantial, occur during periods where the rest of your portfolio is typically taking it on the chin. So it's a really great building block. I mean, I wouldn't do everything you do because these payoffs occur very sporadically and in an unpredictable way. But having part of your commodity investment program in something that tends to benefit when there are these significant exogenous shocks, and the name of one of the most recent significant exogenous shocks is Vladimir, that's its first name. And these things happen, and it's good to have something in there that provides a little bit of, oomph in your portfolio during those situations. And these payoffs, given the highly, to use a $10 word, leptokurtotic distribution, big right tail distribution, can be really impressive. So, one of my first jobs out of graduate school was working at a place called Commodities Corporation, designing trading models there and implementing it. That's the thing that turned into Goldman's alternative group. And there was a guy that they allocated, out of all this billions of dollars, they allocated $10 million to him. That's it. And the reason for it is because I'm convinced he was actively psychotic. So he would do 3 trades a year. He would risk a third of his capital per trade. And it just dawned on him one year that in 1994, which was actually a very bad year for the hedge fund industry, that he should invest in a bunch of calls on the coffee market because supply was such that if there was any kind of a frost that year, it was going to move up. So he loaded up on coffee calls with a third of the capital that they provided him with at about $8.50 a piece. And later in the year, after virtually every coffee tree in Brazil was murdered by a frost, he ended up trading out of those at $1,500 a piece. So, and he got written a check. His incentive payment was $40 million that year. And the firm itself, despite losing money in virtually every other place in this massive portfolio, they did great. Cleaned a lot of messes up. And so the presence of an asset class that has this, highly right tail skewed distribution, if you have someone in there capturing momentum for you in a relatively organized and systematic way, can be a great portfolio construction building block.
Didn't know that Brazilian coffee was such a profitable trade.
It can be.
Happy to know that.
Yeah.
So, given these exogenous shocks, particularly the war in Ukraine, what is the state of commodity volatility in this day and age versus other points in the past? Is it different than 2008?
She's saying we have 15 minutes.
Yeah.
Yeah, we did an analysis on this for an investor because prior to the war in Ukraine, I would say about 6 months ago, we noticed that outside of equities, volatility had been picking up across markets. And when we look back at the daily dollar volatility of all the markets that we trade, commodities plus rates plus fixing plus currencies, it was in approximately the 16th percentile going back to 1986. So it was pretty high. Right before the war, it had gone up to, just a couple of weeks before the war, it had gone up to the 12th percentile. After the breakout of the war, it's top 5, top 3 percentile now. This is the highest volatility that we've seen going back to 1986 in commodity prices.
So, because we all...
Well, I'd like to take a stab at that just a little bit, just to amplify the point that you were making, because I think it's an important one. So volatility in these markets can crop up at any moment, and we're just recently witnessing a pretty substantial increase. But these things are fairly frequent in their occurrence. So we did a study where we took a look at 20 years worth of data. And we just assumed, let's look at 20 different commodities, and let's take a look at weekly price changes and assume that they're normally distributed, which is, they aren't, but let's assume that. And you see a big move in natural gas, you see a big move in copper, and during that 1 week period, how many sigma event was that, okay? And then translate those sigmas into something that's a little bit more intuitive. When's the last time you should have seen something of that order of magnitude? And it turns out you had to represent that time scale in log terms because there's not enough paper that's ever been manufactured to graph that thing. And what we saw was, over a 20-year period, 3 examples where that from a statistical standpoint, under the assumptions of normality, should not have happened, or the last time they would have happened was about 10 trillion years before the universe began. The move in natural gas that flew up Ant-Man, Australopithecus was leaving Africa and moving up into Europe. And there's numbers of these things. We gave a little bit of historical context behind this. But volatility is a persistent factor of the commodity. They do stuff. They get wild and woolly, and you should just understand that that's a feature of those markets.
It's another way of saying that commodity returns are not normally distributed.
Yeah.
And because I want to go to the questions from our audience. Last question from me. Given what is happening right now and how commodity prices are going up, we see already increases in food prices. Can this have substantial impact on the real world? And what does that mean in practical terms? And by the way, does that make commodities and not a very friendly ESG trade? I mean, I'm asking about ESG given everything that's happening, but that's something that is front of mind for many investors. So I'm just wondering about that. How do you approach that when you talk to your clients?
When you think about ESG, it's more what is the policy of a particular equity that you're going to be investing in. There is no policy for wheat. Wheat is the thing that exists. In terms of actually trading it, the studies, and this happened in 2002, 2003, up to into 2006, and I think CalSTRS was one of the ones that was looking at this. Was it socially responsible to invest in commodities? And they found that the commodity indices, even though they were holding long positions, weren't affecting commodity prices. And the trading that goes on is not going to affect the commodity prices. If anything, the liquidity that is provided to the market dampens the volatility and potentially create more stable markets. But in terms of the current situation, with particularly the grain contracts, corn, wheat, sunflower oil, everything that's coming out of Ukraine, it provides, between Ukraine and Russia, 30% of the world's food for grains, wheat. Provides 50% to Europe, provides 50% to Northern Africa. The disruption that's going to occur, and it's happening right now, you see it on the news, due to the war, it's going to create political turmoil in countries that will not have enough food for their citizens. It's a terrible environment, terrible condition that we're in because of this.
Yeah, we were talking about this earlier on this evening, and I will share exactly what I said. I know I shouldn't, but I like to work blue every once in a while. And ESG is a very difficult concept to define with any degree of rigor. So I managed at one point 2 different ESG portfolios, one for a Swedish pension plan and another for the Jehovah's Witnesses. And imagine a Venn diagram where there's nothing overlapping. One was no guns, booze, or porn. The other was I don't want anything that's highly carbon intensive, and you can imagine who was who with respect to that mandate. In fact, I think the Swedish pension plan actually had a minimum ban on porn because it's 20% of their GDP. I'm just kidding. but so, you know, I guess that's part of the whole notion of ESG from my perspective. But yeah, I mean, it's difficult when you have an investment in your portfolio, which to a certain extent will benefit periodically from human suffering. You know, that's just sort of a sad fact of life. So I don't know any other way around it, quite honestly.
Okay. Questions from the audience? Anyone?
I want to go to liquidity. As the Fed reduces the balance sheet, how will that impact the liquidity, saying commodities? And you see that obviously as increasing volatility and opportunities. Or how do you perceive the reduction in the balance sheet impacting your market?
I mean, the reduction of the balance sheet is basically adding more pressure to rates, increasing rates and decreasing bond prices. That combination with the Fed raising rates, I think is just going to increase, the volatility within the commodity markets. And that increase in volatility is going to end up with higher prices. That's what I think the Fed is missing in terms of trying to slow down the economy, is that they're attacking commodity pricing as if they can control inflation with that approach, where they can affect inflation is, wage inflation, it's housing inflation, mortgage rates, but actual commodity pricing, maybe other than oil, people have to eat, people have to build houses, people have to, it's something that is going to end up perhaps in a stagflation type of spiral, where we're going to have slower growth with the higher rates, but commodity prices are still going to increase.
The reduction in the balance sheet, I don't think it's generally understood just what a momentous impact that will have. So just spitballing the math. So we have 9 and change trillion as the Fed's system on the market account, their balance sheet, the stuff that they went out and bought. And they decided they were going to keep it at that level for a very long period of time. Whatever they built it up to, they were going to, whatever matured, they were going to replace. So just spitballing the math on that, call it 10 trillion to keep the math easy. 10-year average maturity, 10% of it's going to roll off on average every year. So they've got to go out and buy $1 trillion worth of bonds every year just to keep it where it is. And when you stop doing that, then there's 80 to 100 billion a month that's not getting taken out of the market. That's basically as big as QE was at its heyday.
It's QT, it's quantitative tightening.
Yeah, and so it is taking stopping QE and doing this at the same time. When between those two colorful activities, they were essentially buying everything that was being offered to the market by the Treasury. Now, the way that works, the way they pay for those bonds, is the money center banks that are primary dealers from whom they purchase these bonds. They have accounts at the Fed. And the Fed pays for them by saying, you now have more money in your account. So this is money that's created in the matrix, literally. And so now that is stopping. And that's going to have a tremendous impact, and I think more so than people give it credit for. So now we've been through this period of this great distortion, and that's a term that's being applied to a world where you can have 10% inflation and at the same time, 2.9% yields are 10 years. And where that makes sense, technically it's in fantasy land. So, you know, we're in for a very interesting time of it over the next little while. And so, yes, indeed, I think it will have an impact. I'm not sure exactly what sort of an impact it's going to have, but it will, you know, reduce liquidity, certainly in fixed income markets. And to the extent that there's financing involved in various commodity positions, it's going to create stress. So, you know, I think, you know, we're waiting to find out at this point.
An inflation question. If you can pay $66,000 for a virtual Bitcoin, will you eventually pay $5,000 or $10,000 for a real gold coin?
So, you know, yeah, Bitcoin's a funny thing. So I was talking with a professor at MIT, her last name is Shore, and she's done a brilliant paper recently on Bitcoin. And what she did was she got a hold of a whole lot of transactional data on Bitcoin and did some fascinating studies on what that market looks like. And essentially what you're dealing with is this distributed ledger where there's all these organizations all over the planet hashing through all of this data and determining what the ledger looks like, who owes what to who. And it works in a sort of a democratic fashion where 51% of the miners, if they agree that something is so, then it is so. And so she got a lot of this data and wanted to examine how robust the system is. And we just assume that it's this massively distributed ledger and it's got to be robust. She did some really clever things. So, for example, there was a big fire at a mine in, of all places, China, and it took their electric grid down for like half the country practically for a brief period of time. And what she was able to see is coinciding with that event, 50% of the world's, you know, miners went offline temporarily. So there's a very large concentration of Bitcoin operations taking place in China at the moment. Because, you know, for whatever reason, I'm not sure what it is. So
Cheap coal.
cheap coal, yeah, it's probably cheap energy and the ability to pollute. And
That's gone.
yeah. And so that whole infrastructure is nowhere near as robust as we think it is. Then, consistent with what goes on in the futures market. So just for sport, typical futures contract, you know, you have hedgers, you have speculators. What proportion of that trading activity do you think is the result of someone actually needing the underlying commodity or providing the underlying commodity? So, well, the answer is about 3%. Most of it is the locals stealing from each other. You know, people trading and speculating. And the same thing, as it turns out, happens to be true within Bitcoin world. But for the most part, of that subset that are not there just simply buzzing around and trading, most of the use cases she was able to determine are things like tax evasion, money laundering, ransomware. You know, it's
All good things.
various miscreants. You know, I mean, it's those are the primary use cases ultimately for that thing. So I have a very dim view of Bitcoin, and I kind of wonder what the future looks like for that, because one of the things that happens to be true is being a government with the ability to issue a currency is one of the most profitable things you can do. There's a word for it. It's called seniorage, and governments are ultimately going to be very loath to give that up in any large scale. So, you know, they'll probably create their own versions of it. But, well, you know, people pay whatever they're going to pay for an asset, a currency. And I'm sorry, if you don't mind, I'll just rattle on for 2 more minutes, and then I'll let you have the rest of the time. But, you know, if you think about what a currency is, generally speaking, it has 3 things that define it. It's good as a medium of exchange, it's good as a store of value, it's good as a unit of account, right? Those are kind of what we think about when we think about money. And ultimately, what it relies upon is people's belief that it's going to be meaningful, right? It's a shared, it's really a psychological motivation for believing that it has value. And there have been, some very extreme situations. So the first people to introduce money, per se, were the Chinese, and they originally had these beautiful things made out of deer hide with nice painting on it, and they would issue those. Essentially, they became documents that evidenced loans, and you could trade them back and forth and use this money. And then they discovered paper, very clever group of people, and that allowed them to produce money a lot faster. And sometime around, I think it was like 500 AD, they had printed so much of this because they realized it's just paper, but we can buy stuff with it and get all those wonderful benefits. And then literally almost overnight, people said, this is bullshit, that's paper. And we just finally figured that out. And it was 300 years before they had money again. So when you take liberties with the currency and print too much of it and behave in an irresponsible way, you're playing with fire. You really are. Everyone's going to have trouble sleeping.
I think the only points that I want to add to that is when you think about gold, you think about an inflation hedge. People have been talking about Bitcoin in that respect, and I do not think that is the proper use for it. When you think about inflation hedging, there's two types of inflation. There's expected inflation and there's unexpected inflation. And commodities as an asset, a group of commodities, are shown to be highly correlated with unexpected inflation. So if you're looking to diversify your portfolio, I think the theme that we're stating here is active management in the commodity space. It is an asset class. It's worthwhile to be in the portfolio. It can hedge out unexpected inflation, and it can help in this particular environment.
And there's some well-known, well-documented risk factors, risk-free within the commodity space, well-documented in both the academic and practitioner literature, where there's really a good explanation with respect to why you deserve to be compensated for taking these risks.
Anyone else?
Sorry, forgive me, I know I'm a little bit late to the party, but
That's all right.
I have a question with regards to ESG and geopolitical considerations. So when you think about just everything that's happened in the last 6 months and then just what's projected to happen, do you see this as amplifying or accelerating the integration of ESG and transition in the commodity space, or do you see this as something which is going to dampen the appetite for these activities given what's happening?
I'm doing a lot of talking, so I'm going to go over to you.
I go back to the statement I made before when it was CalPERS or CalSTRS had done research on us back in the mid-2000s about long commodity players in the market. Are they affecting commodity prices? And the analysis that we came out of this was that it was not pushing prices up. It is just trading the price where it is set by the fundamental conditions. So trading in the marketplace is only adding liquidity and price discovery and dampening the potential volatility of that marketplace, and can only help that market exist, as opposed to something where it will just drive the price up. You're not going to have traders sitting at a table just buying commodities only. We're actively looking to sell commodities that we think are not high with their risk premiums, and buy commodities that are high in risk premiums. And by doing so, we're relieving the pressure from somebody else who needs to sell that commodity. So I think from an ESG point of view, the mathematics of it are going to show that it is not negatively impacting the market environment, and that the liquidity is only helping the market environment.
I took a class when I was in my first year of college. I had no business doing it, but it was a course in political science. And the professor came in and said, we're going to learn about using models to describe behavior. And, some of these models will be normative. They'll tell you the way things should be, and some of them will be descriptive. They'll tell you the way they are, and some of them are predictive. They'll tell you the way things should be, or will be rather. And he says, but then, you know, the only model that ever made any sense to me that seemed to have any predictive ability, I learned about, not in graduate school, but from my dad, who one day told me that people don't move till the water's up to their ass. And there's some truth to that, and we're kind of seeing that now, right? And, you know, I was reading recently that the city of New York, within a decade or so, is going to get all of its electricity from a hydroelectric facility in Quebec, you know, and that's basically clean energy. I mean, you rip up the, you know, when you're creating a dam, you have problems. But I think that maybe the upside to all of this, in terms of ensuring energy security, is a move towards cleaner energy sources, and so that's the silver lining in all of this that we've been experiencing at the moment. So I would say that it probably is having a notable impact. But you know, people are sort of switching to electric cars at the moment. Where I live in Colorado, the Tesla is the dirtiest car on the street. I mean, it you know, 60% of the electricity in Colorado is from burning coal that they get from Wyoming. So you know, and so it's, you know, we're not going in a straight line, but I think we're moving in the right direction. And I think these disruptions, I think to your point, I think they're very helpful. In a painful sort of way, but that's what it takes sometimes.
All right, I think that does it. So thank you very much.
Yeah.
Commodities.